Okay, welcome everybody. We're going to go ahead and get started because it's a couple minutes after 7, and I'm sure some more folks will keep trickling in. And feel free to duck out and get another cookie or a bottle of water if you need it at any time. But I want to thank you so much for being here tonight. I'm Annie Levinsky. I'm the Executive Director of Historic Denver, and this is our 5th forum in the RE Denver series, which we started last summer. And we're really excited to continue to explore all the issues related to the past, present, and future of our built environment. And this spring, we're particularly focusing and continuing to focus our efforts to identify context-sensitive forms for our existing infill. And at one of our last forums in the fall, for anyone who was here in November, we did an exercise trying to find forms that would do just that would be context-sensitive and meet some of the needs related to zoning and housing. And what we found during that exercise was that a lot of the questions and fundamental issues that arose related to the market and the financial side of development. And we wanted to provide an opportunity for people to really explore that particular thread in more depth because it's clearly so important to what drives development in our city, what shapes whether old buildings are saved or new buildings are built and what they look like and where they are. So we're excited to have here tonight several experts. When we talk about historic buildings and historic rehabilitation, we often talk about economic impact and the economic side of the issue. And we talk about the overall positive effect historic preservation has on our local economy. But we also talk about the incentives that exist to help make preservation possible, primarily tax credits, which Colorado has recently updated and which are now far more robust than they were just 2 years ago. However, as historic preservationists, we don't always talk about the market forces that drive demolition or the market forces that affect the kinds of new buildings that are built, whether it's apartments or condos, residential or office, low-rise or mid-rise. Yet zoning and land use regulation play a big part, and but we want to know what else is at play. What factors do developers have to consider? What does it take to build a one-of-a-kind project or a project with strong architectural character? And of course, the question I think we're all curious about tonight, what has made Denver such a hot real estate market? We want to try to answer some of these questions tonight, and we're thrilled to have 3 experts here to tackle a different part of this topic and to engage you in understanding the trends and outcomes that are shaped by market matters. I want to thank each of them for taking the time to be with us tonight, and to thank the National Trust for Historic Preservation for the grant funds that have made it possible for us to not only draw local speakers, but national perspectives as well. And we do have a visiting speaker from out of state in Mallach tonight who can bring that perspective. The RE Denver series is one component of Historic Denver's Investing in Action for the Places You Love capital and capacity building campaign. And this is a campaign that seeks to raise, as a portion of it, $500,000 specifically to advance ideas and actions for the places that make Denver unique. We have raised more than 80% of our total campaign goal, and I hope that you will consider becoming engaged in our work tonight, either by contributing to the campaign or becoming a member of Historic Denver. We have membership brochures and other materials out in the lobby, and our development associate, Sarah, is out there and can answer any questions if you're curious for more information. A little note on our format tonight. Each of our 3 presenters will have approximately 20 minutes to speak, and each will pose either hypothetical or direct questions to you so that you can stay on your toes and be engaged. So I'd now like to invite our first speaker, and I'll give an introduction. Glenn Mueller is here. He's a professor at the Burns School of Real Estate and Construction Management at the University of Denver. He has 35 years of real estate experience, including 26 years of research, including market analysis, real estate securities analysis, real estate capital markets, portfolio and diversification analysis, senior housing analysis, and public and private market investment strategies. He also is a real estate investment strategist at Dividend Capital Group. He has great in-depth knowledge, and we're really looking forward to hearing from him. So, come on up, Glenn.
Well, thank you. Thank you very much for having me here. Just kind of quick expansion. University of Denver's real estate program is actually the 2nd oldest in the country, only behind University of Wisconsin. It was started in 1938, so we've been doing this for quite a while. As I start to talk to students about real estate, and if you will, let's take real estate and really break it into 2 components, okay? One is home ownership, and by that I mean houses, condominiums, townhomes. And as a business, that is a production business just like cars. You take raw materials, land, sticks and bricks, put them together, have a finished product, and you don't make any money until you sell the house to someone. And your house is really a use asset. It's just like your car. It's expensive to maintain and operate, but it's a necessary part of your everyday life. The other part of real estate that I'm going to talk about, so you kind of have the big picture perspective, is income producing real estate. Many of you have probably heard the term commercial real estate. I like using income because it adds in an additional property type over what you'd think of in commercial. Most people think of office, industrial, retail, and hotels, but apartments are income producing. The tenants don't own them, they rent them. So that part of real estate is important, and it's a very large portion. If you looked at housing and income producing real estate size-wise in the United States, they're almost the same in size as far as their dollar value. So, they are complementary, and we'll talk a little bit about them. As I start to talk about real estate to my students, I always tell them that there are 5 major macroeconomic factors that drive demand for real estate of all types. It starts with population growth at the bottom. The United States is growing at a rate of 0.9% a year, which doesn't sound like a lot, but the population of the United States is 330 million people. So we're growing at about 3 million people a year. And if I can put that into real estate perspective for you, that means that we need to build a city the size of Denver, Colorado, which is about to reach 3 million people every single year, to give those people a place to eat, sleep, shop, play, pray, etc. So it's a very important part of our economy. I did a study a few years ago with University of Colorado, and we found that real estate, the income producing side of real estate in the state of Colorado basically is about 12% of the state's gross state product. You've probably heard of GDP, gross domestic product, which is one of my key variables here. Gross state product is the same thing, but just for the state. So it's one of the large industries in the country. GDP is important. It's the output of our country. When it's negative, as you can see in 2009, it takes 3/4 of negative GDP growth to have a recession. GDP has been growing at a rate of about 2% for the past 15 years, which is much slower than it was back in the 70s, 80s, and 90s when it was growing at 3 to 6%. Okay, so we're a slower growing economy than we used to be. Compare that to China. Their GDP growth had been close to 10% for the past decade. Employment growth is really the key driving factor, if you will, for all real estate, because people that have jobs use real estate. Wherever you have a job, you work in real estate. If you have a job and work in real estate, then you can afford to buy a home, or you can afford to rent an apartment. The other factors that are important, okay, now I understand, are inflation, because the cost to operate real estate, the cost for you to own your home, goes up every year. So we always look at that to make sure that we can afford to continue to maintain and operate the properties that we have. And then interest rates. And the 2 interest rates are a short-term rate, like the prime rate that a bank will lend to you when you're in business. And so people that are constructing homes typically watch that, because they get a short-term construction loan to build the building that they're going to sell to you, or that they're going to sell to an investor who's going to invest in it for a long rate. The other one is 10-year treasuries, because that's the benchmark for making mortgage loans. In income-producing real estate, you can't get a loan any longer than 10 years. If interest rates are moving up, your cost on your loan is going to go up as well. So those are the 4 key factors that we watch. And as you can see here right now, we have low inflation and very low interest rates. 10-year treasuries are also known as the risk-free rate. In other words, if you don't want to lose money, you'd invest in a government bond, and you would absolutely get your principal back, because the government will never default on their bonds. For the past 5 years, the 10-year treasury rate has been running about 2%. For the past 5 years, every economist in the country is saying it's going to go up, and projected that within 2 or 3 years it would be at 5%. Government treasuries closed yesterday at 1.8%. The volatile stock market makes people nervous, so they pull their money out of the stock market, and they stick it into a safe rate like a government treasury bond. More money coming in means higher prices and therefore lower rates, and that's why interest rates have been so low for so long. That's actually good for real estate because our cost to manage and own properties and finance them goes down. So I became a professor at University of Denver in 1986. In 1990, I was enticed away to go to Prudential Insurance Company in their real estate group. At that point in time, they were the largest investor in real estate in the country, with about $40 billion of real estate, as well as we advised major investors, what we call institutional investors, which are basically pension funds and endowments. One of my major clients happened to be the state of Colorado's public employee retirement system, and I've worked with them for many years. What I found was that just like the economy goes through cycles, we have recovery periods, we have expansion periods, we have recessions. Real estate does the same thing. And there's a physical cycle to real estate, which is demand and supply for space. That tells us where occupancies, or how many people are renting, are going to go, and that drives rent rates. And when things are bad and we're at the bottom in a recovery, we get very low rental growth. When things are doing well, in the expansion phase, we get high and rising rents. And you notice there, point 8 is in green. That's a very important point because that's where rents are high enough to make it cost feasible to start building a new building. So for instance, if it costs $300 a square foot to build a new office building here in Denver, and investors who are going to invest in the high risk of developing new properties need a 10% rate of return, 300 times 10% means that rents in the Denver area have to be $30 a square foot to be able to cost justify building that new building. Before that, we get very little new building going on. We might rehab buildings and do other things, but we need that rent to make it go. We just started to hit $30 a square foot in office rental rates last year, and that's why you're starting to see new buildings going up. So remember that as a key rate. We eventually hit a peak, and at some point in time, demand and supply are growing at the same point in time. Love it if we could just continue on forever at that rate. But what happens is when supply starts rising faster than demand because we're building too much, or when we have a recession, we're building and employing at the same rate, but all of a sudden employment drops off because of a recession, like the dot-com bubble bursting back in 2000, 2001, like the recession that we just had, et cetera. We started into the hypersupply phase and the recession phase. So I've done a study that I published that looks at rent growth, and you can see at the bottom, rent is growing at a rate that's negative. As we start to recover positions 2, 3, 4, 5, we get to a point of our long-term average, and at point 6, rents are growing at 4%. That was the same rate as inflation between 1968 and 1997. Then you see very high rent growth up near the peak, 12, 11%, et cetera, and then it falls back down. So I study and watch markets in the 5 major income-producing property types, the first being office. And today, office is at position 5. It's still recovering. It hasn't reached its long-term average yet. The U.S. economy, on the other hand, right now, depending upon which economist you talk to, is going to tell you that we're probably at about position 8 to position 9 in this economic cycle. So office is lagging. Why? Because today, we're actually putting less people into the same, or putting more people into the same amount of space. It used to be that the average space per worker was 200 square feet. Today, we're actually cramming them into 110 square feet per person. Why? Because first of all, there's job sharing, people working at home, not even a cubicle today, but they may have a bench that they work at. They have collaborative space that they work together. The young millennial generation is much more used to a smaller space and the flexibility of with their computers of not having to have a lot of paper and files and everything else. Look at Denver here. It's at position 5 at the same place as the nation. So it's growing at about the same rate. Move to industrial, warehouses, the small research and development spaces that you see. If you went to like Sears to have your vacuum cleaner repaired or something like that, you go to a smaller industrial space, okay? The national average is at 0.9. It's actually about at or above where the economy is doing because we buy more stuff, right? When I was a kid, I had 2 choices, Coke and Pepsi, right? today I've got Coke, Diet Coke, Cherry Coke, Vanilla Coke, Coke Zero, etc. And so the store all of a sudden has to stock. A normal grocery store used to have 40,000 SKUs, shopkeeping units, the little barcode that you scan to buy things. Today they have 120,000 of them. So there's a lot of demand for warehouse because people want stuff to come in quickly. Obviously, e-commerce, you can buy things online. Help. Where's Denver? Denver's way ahead of that. It's at the top. Why is there so much demand for a warehouse in Denver? I call it the pot effect, right? Denver's a couple of years ago, Denver's occupancy level was about 90% in warehouse space. Today it's 99%. Rents used to be $3 a square foot 4 years ago. Today they're $6 a square foot. Why? Because there's that much demand and we aren't building enough supply. Look at apartments and notice that the national average is at the peak of the cycle, and Denver is over the top at position 12. The millennial generation is coming of age, they're coming out of school, they're getting jobs, and they're renting. The average age of a first-time home buyer in the United States, anybody want to take a guess? I got 26, 32, 28, 36 years old. Why so high? Because remember that only about 25% of all our population are college graduates, and all the blue-collar workers get out of school, get a job, immediately go in debt to buy a car, typically don't get any help from their parents, and it takes them, and then get married and have kids, and it takes them a long time to save up the down payment to be able to buy a home. So 36 is the average age of a first-time home buyer in the United States today. That's pretty incredible, is it not? But right now, the millennial generation, we are graduating 8,000 or 80,000 of them a year, and they're coming into the workforce. Denver's population is growing dramatically, and we have the need, if you will, for about 8,000 new housing units, apartment units every year. That's great. So Denver should be booming from that standpoint, and they are. As if you've been downtown, they all are interested in living downtown, and we're moving that up, right? The problem is that apartments are one of the easier products to get a loan for because the government agencies, you've probably heard of Fannie Mae, Freddie Mac, Ginnie Mae, that make that help give you housing loans, for a home loan. They also do apartment loans, and if you can get the permanent loan, you can get the construction loan. So we are, if you will, overbuilding. 2 years ago, we built 8,000 units a year, just right. Last year, we built 10,000 units a year. In that year, 2,000 too many. This year, we have 12,000 under construction, so we're overbuilding. Hence, we've got more supply than demand, and we've come over the top and are starting down. If we could back that off, that millennial generation keeps graduating for the next 10 years, there's a very strong and consistent demand coming along that will be valuable for the country. If we look at retail, national average is right there where the country is. Denver is doing a little bit better. We are big consumers here. We love our outdoors and we love spending money. Our cost of living is right about at or just slightly below the U.S. average, so we have a little bit more disposable income, and so the Denver retail market is doing well. And finally, hotels. You can see that the hotel market is doing very, very well at position 10. During the dot-com bubble burst, we didn't build a lot of new hotels. We have more and more people as the economy gets better traveling, both for leisure and for business. Hence, there's good demand, and you can see that Denver is at its peak right now. Normal average, long-term average occupancy for hotels is about 65%. They don't rent every single night, obviously. Friday nights and Sunday nights are typically the two slowest days of the week for them. Here in Denver, things are booming. People are coming. We have a whole new tourist category of marijuana tourism that's creating demand for hotels. So let's take a look at apartments and That's not showing up. I was going to show kind of the historic long-term cycles of what's going on. I also forecast, and here I think that the entire nation will be over the top and into the hypersupply phase, heading back towards long-term average by the end of this year, and Denver back to its long-term average because of all these extra units. If you're involved in the apartment markets at all today, what you find is for the past 4 years in a row, Denver's been able to raise rents. Apartment rents have gone up at an average of 8% a year. Inflation's 2. That means things are getting very expensive. If you have a chance to go see the Platform building, which is a new apartment building that was just completed downtown, literally just west of Union Station, walk out of Union Station to the west, cross over the tracks, and you're at the Platform building. A 600 square foot efficiency apartment, not even a one bedroom, goes for $1,800 a month. But big demand for it. You know, the young millennials want to be there. Now let's turn and talk a little bit about prices and what's happening to prices. It is capital flow that affects prices. So if everybody thinks that the stock market's going to do well and they start buying stock, the stock market goes up. When everybody says, oh, I'm worried about this, pull out of the stock market, and they put it into bonds, bond prices go up, and their yields go down. Real estate's really a third asset class that major investors look at. And if we looked at the value of real estate that they can invest in, they can't invest in your house. They might make you a mortgage, but they can't invest in your house and its price appreciation. If we look at the stock market today, 26 trillion, the bond market, 38 trillion, U.S. income producing real estate is 18 trillion. It's 22% of that universe. So when we look at all these pension funds and endowments, and yours probably does this too, your pension fund, if you have one, they allocate somewhere between 5 and 20%. My retirement from the university is with a company called TIAA-CREF. Go down Broadway and look up, and one of the tallest buildings has TIAA-CREF on the top, Teachers Insurance Annuity Association. They have a $8 billion real estate portfolio that I am invested in as one of the participants in the retirement system. Good example of what they own. You've probably seen the office building, the very nice looking office building at the corner of Colorado Boulevard and I-25 on the southeast corner where the Dave & Buster's is. TIAA-CREF owns that. So all the people renting in there are helping to put money away for my retirement. So allocation to real estate is important. 10-year treasuries historically have an average yield in my lifetime over the past 60 years of 6%. Today, the 10-year treasury is at 1.8. Where do you think it's going to go from here? Can it go down further? No. And so if it goes up, that means that the value of my bond drops, and that's why people are allocating out of other things and into real estate. Here's capital, money flowing into real estate in billions of dollars. So you can see here a little under $100 billion back in 2001. During the peak of the economy in 2007, $400 billion. During the Great Recession, dropped off to $50 billion, and it's coming back. That line on the top is the price index, and you can see that as more capital flows in, the prices go up, capital comes out, prices go down, capital flows back in, prices go back up, and so prices are moving up today. And basically my first job was actually, after I graduated from DU, was at United Bank in Denver. It's now the Wells Fargo building, the building that looks like a cash register on the top. That's where my first job was. And when I started in there, I became an analyst doing real estate back in the 70s. And what I found was that it was a local buyer, local seller, local bank doing the financing. In the 1980s, these pension funds and endowments started to get into it, national buyers, national sellers, national financing. In the 1990s, all of a sudden, real estate got access to the public capital markets, and we started creating public companies called REITs, real estate investment trusts. And what they do is they buy properties, and you buy their stock. They turn around, take that money, and buy properties. And all of a sudden, we had equity through REITs. Commercial mortgage-backed securities for debt. And since the year 2000, the real estate world has gone global. This shows capital, and I'm sorry, but what you're seeing is There's actually, in a very light color behind there, is a map of the world. To the left-hand side is the United States, to the right-hand side is Europe, and to the bottom right corner is Asia, and you can see AUS, Australia, on the bottom. This shows U.S. money in blue going to other countries where we're investing overseas, and then other countries coming and investing in the United States. So real estate is now a global business with things going on all over the world. So real estate has changed greatly. How it works, in other words, where companies decide to locate is based on a lot of different things. And what they're looking for today is one of their most important assets is their employees. And today, as my generation starts to come to retirement, they're looking for millennials to replace us, right? And so the question is, where do they want to live? And where they want to live is important, and many companies are choosing Denver because millennials want to live here. And many kids, I've had many students who've graduated go, okay, I've decided I want to work. I have one of my best students. I decided that I really want to be in San Francisco. So I'm going to move there and then find a job. When I was a kid, you took whatever job you could get and went wherever the company told you you had to go. Today, the millennials seem to have more confidence about the fact that they can get a job. They don't expect to stay in their job as long. So you have to find an environment that they're attracted to bring them in and keep things going. The money to do all this, whether it's restoring a historic building or doing whatever, is important because it is the capital that drives preservation and development as we go through. So with that, I will let you introduce the next speaker.
All right, so our next speaker is Cassie Wright. And Cassie actually first met when she was a planner working at the Downtown Denver Partnership, and we discovered we were neighbors. But now she's a project manager for Urban Ventures, which is a real estate company that is dedicated to creating healthy, sustainable communities. Cassie works on all aspects of real estate development, from land acquisition to project construction. She tests the financial feasibility of projects, actively participates in site planning and design, and develops marketing and sales-related materials. So Cassie's going to talk a little more specifically from a developer's perspective about how they approach a project and some of the variables that can influence it. And she has brought some data and examples she can give related to pro forma if you have specific questions for her about how that works and how fluctuations can affect it. So Cassie, come on up.
Hi, everybody. My name is Cassie Wright, as Annie mentioned, and Urban Ventures is a small development firm. We specialize in projects specifically in the city and county of Denver, and we tend to value adaptive reuse projects. So there's actually an image here of one of our current plans in process, which is called Steam on the Platte. That is a project that's over by the Decatur Federal Light Rail Station at 14th and Zuni, where the U-Haul is, if you are familiar with that place. So our first phase of that project, we're redeveloping a warehouse space. We're also working on another project up in Northwest Denver right now called ARIA, and that also has an adaptive reuse component of an existing convent. We purchased that from the Sisters of St. Francis. So I just wanted to give you a little bit of background. We believe in doing the right thing, and we're trying to do that all the time, but sometimes financial expectations can get in the way. So I wanted to talk through not only what we do as developers, because a lot of times people just don't understand or don't know what the processes are that we go through. And in fact, a lot of times when people ask me, well, what do you do? And I say, oh, I'm in real estate, they say, oh, you're a broker. And I'm like, not exactly. So I'm going to walk you through that process and then ask you some questions about or show you some examples of how different values of land can affect the bottom line, as well as how different sales prices can affect the bottom line. Like I said, we try to provide a lot of affordable housing, but sometimes it's just not quite feasible. Okay. So some people, Oh, my slide's a little bit cut off. There's supposed to be a chicken on the right, not just an egg. So the question is always, how do you figure out where you're going to build? Do you go out and just drive around and look for cool sites? Or do you take your vision and kind of ride with that first? And I think it kind of is a chicken and egg scenario. The first example I gave you of the Steam on the Platte project, we were actually consultants on another visioning process with the city on what can happen along the Platte River. And so we kind of saw this site during the recession when nothing was happening. We're like, ooh, wow, that's really cool. It might be interesting to explore that as the economy turns. The other case, the Aria Denver development in Northwest Denver, the Sisters of St. Francis owned that land. They were working with another developer. That developer couldn't get the numbers to work, and they said, well, what other developers are out there that share the same values that we do? The sisters have a commitment to community development. They have a commitment to sustainability. And so they called us, which is kind of weird to get a phone call from a nun if you're a developer. But so I just wanted to let you know that it kind of happens both ways. The second step, after you find that land, you have to start figuring out, how do you value it? I mean, anybody can ask any price for land, but what can you actually financially back up is the next step. So we typically will contact a broker and we'll say, is this land that's for sale kind of in line with other market comps or comparables? We typically will back into the land value by saying, well, what could we fit on the site? Could we just fit 2 single-family homes, or could we fit, a huge condominium project? The more sales, obviously, the higher the land value can be. Once we kind of flesh that out a little bit, then we go and make an offer, and the negotiations begin. This is kind of nerve-wracking. This is a weird slide system, so I apologize. The third step is really understanding the land. Most people are like, oh, you buy the land, great, you just start building stuff. Not so much, especially because we build in downtown Denver or the Denver central area. Most of the work we do is redeveloping a site. So a lot of times, there are environmental issues related to the site. So we have stacks and stacks and stacks of paperwork that we need to go through after we're under contract for the land. We have a period of time called a due diligence period where we can do all that research, look at the environmental issues, try to understand what was there before, what risks are there, what can't we see? What is there asbestos in the dirt? Well, then is there asbestos in the building materials? All of those things are fleshed out at the very beginning. And I also want to point out that as we're going through this process, we're putting out a lot of cash without anything, tangible that we can actually develop yet. So right now, during this phase, we've already, secured the land by at least putting some sort of deposit on it. Then we're hiring attorneys, environmental specialists. Sometimes we will hire architects to understand the zoning and see what flexibility we have there. So this is really the time that we have to evaluate, again, the feasibility of the site, but sometimes this process can cost several thousands of dollars. I'm presenting this in a way that is very linear and logical, but I will tell you that it doesn't always go step by step by step like this. The next thing we do, and this can sometimes even come back in the beginning when we're valuing the land, is we'll hire a landscape architect or another architect to start scoping out how much can actually fit on a site. This half site plan on the right is of Aria Denver. That red building in the middle is the existing convent. There's 17.5 acres around that. So we have to start laying out, okay, what are these different building types? Well, in the lower right there, we have apartment buildings. There's another apartment building to the north of it. the little cluster of kind of brown townhomes, brown buildings in the upper right are called pocket neighborhood units. So those are 4 and 6 plexes. We like to mix up the architectural context in our developments, especially one of this size. Like I said, 17 and a half acres is a lot of land. To do that, we actually have to hire architects and, again, expend more money to just figure out what that building footprint is and how it fits onto the site. These site plans typically will also show, in addition to the building footprint, we have to contact with engineers to figure out what our roadway designs will be so we can determine how much space needs to be used for roads. Again, it's kind of an iterative process. At this point, we still aren't selling anything. We might be at, we may be under contract at this point. This site planning process can take, a few months. It can take up to a year. It really depends on what the case is. We also do a lot of talking to people. Again, sometimes before we even close a deal and go under contract, sometimes this keeps occurring it always occurs throughout the process, but the reason that we talk to all these different representatives, city planners, council members, etc., is to kind of test the risk. What is the community like? Do they want development? Do they not want development? Because all of those things can either, they can affect the timeline of a project. And that's really important to know too, that the timeline, in addition to just the cash out and cash in, is really critical. If you were asked, would you like to invest $10 million in this development with a promise that you'll get paid 15 in a year, that might sound pretty okay. But if you are told as an investor, I want you to invest $10 million now, and you might get $15 million back in 4 years, because there's community opposition, because the building department is slow, because they're overwhelmed with permitting processes, you would value that deal differently. You'd say, well, if I can put $10 million into this project and get $15 million back in 1 year, or I can put $10 million into this other project and get $15 million back in 4 years, that all affects your decision to invest, just like it affects our investors' decisions to provide equity for our projects. Design and engineering, I already talked about a little bit, but there's a lot that goes into it. We need to not only figure out, again, the land development piece of it, the roadways, the utility design, the parks and landscaping. We also need to start developing more refined floor plans, both interior and exterior plans, the building structures, the heating systems. Again, this is still a step where we're still paying a lot of consultants and experts money to help us develop an overall vision for the site or for the building. So again, this is another step. Each one of these steps has a little bit of risk associated to it, right? What if we're designing our roadways and all of a sudden we figure out, after we look at a survey, that there's a big water line underneath it, and now we can no longer build on that space. So there are a lot of factors involved, and along the way, we uncover different challenges and sometimes opportunities in this process. I kind of laugh because we put this as step 7, but really finding the money starts at the very beginning, and then you have to adjust your process, right? So if you start down the road and you say, we're going to invest $10 million in this project, but all of a sudden you see an opportunity to do a really, really interesting and unique landscape design to approach the river in the case of Steam on the Platte, and you're like, wow, this could be a real missed opportunity if we don't put extra money into this landscaping. So we're constantly reevaluating how much money we'll need and how much money will help us achieve our vision versus really, or on the reverse side, it's like if we don't do this, how will it impact the built environment, the city, the place that we live in? So we always have these trade-offs throughout the process, and we have to decide, are these extra amenities worth going back to our investors and asking for more funding? Or do we, on the other side, work with our contractors to say, how can we value engineer this project to still make for a great place without going back to find money? Typically, equity partners are contributing about 25 to 30% of our overall project budget. So again, if you have a $10 million project, that equity comes in at the beginning. A lot of times we're spending that money down. Typically, our design and other related costs are 25% of the construction costs. So you can see if we have an equity requirement of 25%, sometimes all of that money, most of that money, is spent before we even get a shovel in the ground. After we have a design, we have the money, we know what our plan is, we have to go through the entitlement and permitting process. This varies from jurisdiction to jurisdiction. As you know, different cities have different rules and requirements for density, amenities, open space, etc. Most of the building-related codes are universal. There's a universal building code, so that doesn't vary so much. But truly, just trying to figure out and get through this entitlement and permitting process, it can change from city to city, which is why, truthfully, we tend to typically invest our efforts in Denver because we kind of know the process. And we know that we're going to if the permit department is 12 weeks here, we know we can count on that. In cases where the economy is strong, like we have now, and the permit department is getting overloaded, we start to lose control of how much time it'll take for our building to get through that process. So there again, back to that, if you're going to invest $10 million in a project and you expect it to complete in a year and you'll make 5 more off of that, if the permitting process is delayed, that just pushes your time frame out and gives your investors less interest in a project. So this one in particular is really tricky right now for us and many other developers. The building department, to no fault of their own, is very backlogged. So that kind of fluctuation in time to get a permit or a site plan approved it makes my palms sweat. So after we finally get our permits and all of our approvals in place from the city, that's the point that we start to build. Typically, we'll do some infrastructure development almost every time. We have to either upgrade the utilities because we do have, again, most of the work that we do is on existing sites. And even though a lot of people are like, well, why would you have to spend money on utilities? Well, a lot of the infrastructure in Denver is 100 years old. So, you start thinking, okay, that's another added cost. Well, how much does that cost? It kind of depends. We have a project, again, that ARIA project up in northwest Denver. Just to build the streets and utilities for that project, 17.5 acres, is somewhere around $15 million, just to give you a sense. And that's, again, not giving us anything that we can sell. It's just building the stuff that we need in order to build the buildings. After we do that, then we start building the vertical construction, and again, a lot of things can come up throughout that process. If anything on your plans, if the contractor, for example, reads your plans and anything is missing, then they issue what's called a change order request. If that happens in the field, if we haven't done our job early on and planned for every single alternative that we can, and that arises in the field, the cost is astronomical. Not only that, but let's say we find a problem in our drawings from our architects that say, the bathroom should be, the sewer and bathroom should be here, but then on another plan set, it says it should be in a different location. It takes us time to correct that, and in this market, because there's such high demand for all the trades, if we have to take a handful of extra weeks to remedy one thing, We have already lined up all of our subcontractors, from framers to plumbers. They line up back to back to back to back. And if one of those gets pushed back, then all of a sudden, maybe the plumber that was supposed to start on Monday gets pushed back to start on Friday. And in this market, he's like, well, I don't want to wait 4 days, so I'm going to go to this other job. And then on Friday, he's no longer available for us. Again, draws out that process. Can you advance the slide, please? Okay. The final step to development is to sell or lease the property. And our company typically sells housing. We're housing developers. We do mixed-use projects. Sometimes we will build and hold an office space for a time, but typically that's not our model. In that process, we have to hire, again, outside professionals. I think you're hearing a theme. We don't do a lot of work in-house. We hire a lot of outside professionals to help us do that. Those professionals test our assumptions that we went into sometimes over a year before, when we've analyzed our return on our equity. We go back and we say, okay, is pricing still where we thought it should be at this point? And if it's not, if it's lower, then we have a problem, right? So we have to reduce our prices, and that affects our bottom line. Again, because this development process is so long, sometimes, well, I'll just say for the case of Aria Denver, we purchased that land in 2008. We currently have 13 townhomes and 72 apartments built on it, because the process has been, first of all, we weren't going to build during this recession, but then after the economy started coming back, you have several months of design that goes into place before you even break ground. Typically, on just a standard building, for example, the warehouse building that we're developing over at 14th and Zuni, our design process is approximately 10 months, and then the build process is another 8 or 10 months after that. So you can see, based on the previous speakers' slides, that timeline can really allow for a lot of fluctuation in the economy, and to try to plan for that is tricky. Our projects aren't as complex that I'm talking about now as some of these other high-rises that could have a much longer development cycle. So again, trying to just plan for those fluctuations and changes are what we do in our business. Finally, our final step is, if after we close out all of our, or we sell all of our properties, we will take that profit and reinvest. So again, if our profit margin shrinks to a lower rate of return than what we had expected, we have less money to reinvest in the community in our next project. So again, controlling all those different factors, trying to mitigate all of those risks along the way, and especially trying to control the time that it takes, is really critical so that we can actually take our funds and reinvest in a new project. I have a slide that says questions, but I think that maybe there's number 3 question on the chart, and I forget what it says. What happens to the bottom line if the zoning of a property changes midway through the development process? I kind of talked about that, about the, if the project gets drawn out longer, then obviously your return on investment is less, because you can spend your money in a different place and get a return more quickly. So therefore your money is of higher value in that faster process. If the zoning of the property changes midway, let's say there's a group that opposes the density on a particular site, and I, as a developer, was planning to build 24 houses and now can only build 12. That cuts everything in half virtually. The other thing that can happen, if this zoning of the property changes not even midway through the development process, what do you think happens to the land value? Let's say the land value is at $1.2 million. The zoning changes, allows for more density. What happens to the land cost? I see some thumbs up. That's right. It goes up because the landholder knows you can build more product, you can sell more product, you can lease more product, therefore I can drive the cost up. I'm going to show you an example, hopefully. Here's one case. All other things being equal, the architecture fees, the permitting fees, the number of units, all of that stays the same. You start with a land value of 1.6 million. We get it all to pencil out just right. If the zoning changes right before we're ready to go under contract and all of a sudden the landowner says, well, we're going to increase that cost to $2 million, it reduces that rate of return. I would say most investors would not invest in something that doesn't return at least a 15% return, especially in this market. So our deal would be done after spending a lot of time kind of doing all of that other preliminary due diligence. Situation 2, we believe in affordable housing. We try our best to do it in every project that we build, every project. So we have figured out a way, in the first case scenario, to build a 68-unit project where we have 12 units that are affordable, and we can make a rate of return at 15.8%. Now, in this market where there is very little affordable housing coming online, we and other developers are getting a lot of pressure to increase the number of affordable units. The affordable units, their sales prices are set by the city and the Department of Housing and Urban Development. So we can we can sell an affordable unit that is a 2-bedroom unit in the city and county of Denver for approximately $218,000. The city gives us a subsidy of $6,500 per unit if we're in, there's different areas of need, so it kind of depends. There's a low, a medium, and a high zone of need. So that subsidy will vary from those, but in the case that I'm talking about here, well, it's a little bit different, but generally speaking, in this pro forma scenario, we're receiving $6,500 a unit as an incentive from the city. However, the gap to build this right now is about $100,000 a unit. What that means is for every unit that we want to build and sell as affordable, there's a $100,000 gap we have to fill, and the city provides us $6,500 of that gap. So we have to figure out a way to offset that if we want to actually build and deliver affordable housing in Denver. So just to show you what happens, again, all things being equal, the land is the same, all of the architecture fees are the same, everything is the same. If we try to say we need way more affordable units, and we don't want to see any more of these $600,000 homes going up all over the city, our return, we lose money on this project. The only reason I wanted to show this is very simplified, but I just wanted to show some of the challenges that we face in trying to do the right thing. We're still working our tails off to do it, but these are kind of some of the economics that we're facing.
All right, thank you, Cassie, and I promise you will all have a chance to ask follow-up questions of all the speakers. But first, I want to introduce Alan Mallach, who has traveled to be with us today. He's with the Center for Community Progress, a city planner, advocate, and writer. He is nationally known for his work on housing, economic development, and urban revitalization. He has worked with local governments and community organizations across the country to develop creative policies and strategies to rebuild cities and neighborhoods. Alan has specifically done a lot of work in cities like Detroit and Pittsburgh, where the markets can be very different, but we're excited to have him here and offer a little perspective on Denver.
Thank you, Annie, and I can tell you that the cities where I'm usually speaking would kill to have your problems. They would go beyond, they would kill, maim, and dismember to have your problems. But clearly they have no control over the matter. So I'm going to try to tie some of these points together. And I'm going to start out by going through some very quick slides about just to give you a context of what is actually happening in the housing market in the city of Denver currently. So if we look at, oops, wrong one. This is a very tricky little gizmo here. Okay, yeah. Wait a second. Okay, now I got it. Okay, the first thing is that unlike in much of the country, house prices have still not recovered, have not gotten back to the peak, or are just barely getting back to the peak that they were in 2006, 2007. Denver, when cities like Las Vegas and Miami and Phoenix nosedived, Denver barely had a hiccup. And since then, it righted itself, and house prices today are roughly 30% higher than they were at the time of the peak of what's been known as the housing bubble. If we compare this to other cities that were in the same basic price place as Denver 20 years ago, Denver clearly has just outstripped places like Albuquerque. Bear in mind, again, 20 years ago, the median price in those 5 cities, Denver, Durham, Albuquerque, Chicago, Miami, was basically the same. Today, as you can see, Denver has just taken off and left these cities in the dust, with one exception, which is Portland. That arrow seems to have gotten out of place. Portland has, those of you who are familiar with Portland, Oregon, you know a lot of the same issues that people are talking about in Denver are being talked about and are matters of concern in terms of the development, change in neighborhoods, price increases, and so forth. So these are 2 cities that are very close to each other. The thing is that the rents in Denver have risen at an even faster rate, significantly faster rate than sales prices in the last year. This is amazing. The median 2-bedroom rent from 2011 to 2015 has gone up by over 50%, from $1,200 to almost $1,900 a month. This is astonishing and is, again, far more than in most cities. The other thing that's fascinating, and this is particularly interesting, is if you compare the trend in building permits. Now, building permits, as everywhere else in the country, building permits dropped in Denver during the recession. They dropped significantly, but they came back very quickly, but with a difference. If you compare 2005 to 2014, first, the number of permits has almost doubled, but the increase has been entirely in multifamily housing. 10 years ago, 2/3 of the permits in the city of Denver were for single-family homes, 1/3 for apartments. Today, almost 3/4 are for apartments. So even though single-family production has still not quite gotten back to the levels of 10 years ago, multifamily production has vastly outstripped the levels of 5 years ago. And for the last 3 years, the city of Denver has issued between 4,000 and 5,000 permits a year for multifamily properties. And again, in a city which still, while the metro has about 3 million people, the city of Denver only contains a little more than 20% of the metro population. It's currently, the estimate is that there's about 660,000 people in Denver, or about 250 to 300,000 households. So that rate of production is extremely high. And as you know, I haven't been back to Denver for a few years. And when I came in this morning, and when I was driven around by Annie this afternoon, it blew my mind. There has been so much change in the units, the housing units, the apartment buildings, the downtown, and so forth. It is amazing. And the principal reason is this, and it's changed even more since then. This was between 2000 and 2010. This was what the state estimates was the net migration to Denver during that period. And so what you can see is Denver has become a millennial magnet. Denver, at least up through 2010, still had a negative net migration with respect to people who were older or younger. But in that millennial age group, Denver was seeing a significant net migration, and the numbers since 2010 have increased significantly more. And I think Professor Mueller made an important point when he talked about people in the millennial generation are moving to places because of the lifestyle and because of the amenities that they expect to find there. And then they'll figure out how to earn a living once they get there. And Denver, for all kinds of reasons, has become is widely seen as a city which has the amenities that attract that population, and they're coming in significant numbers. So, what does this mean? Okay, first point is that this group, young, well-educated, middle to upper income, single people and couples, are driving the Denver housing market, number one. Number two, the great majority of these people are looking for high-density, walkable, mixed-use environments. Number three, and this is only the natural corollary, most developers are going to build to where the market demand is strongest, because that's obviously the most profitable opportunities that the market provides developers. So that's the basic driving force behind the Denver market. That doesn't mean there aren't other factors, but this is the dominant one. So what is that, taking it a step further, how does this relate to zoning? Okay, the first thing is zoning basically defines the maximum that one can do with a piece of property. If, as is true in a lot of Denver's residential neighborhoods, the zoning permits a 3-story building with 50% land coverage, which translates out to a floor area ratio of 1.5. And what that means is if you have a piece of property that's 20,000 square feet, you can put 30,000 square feet of building on that. That's the maximum. Now, there are many environments where and again, it goes back to what is the nature of your market. I remember I've done a lot of work in development in New Jersey, and I remember a period, goes back a ways, when, for a lot of reasons, when the market came out of not this recent recession, but the previous one at the end of the 80s, the demand was for single-family houses. But for a lot of reasons, towns had zoned huge amounts of land for multifamily development. And the upshot was that developers were coming in and building significantly under the zoning envelope, because that was where the demand was for the single-family product. But where the demand is for high-density development, as is the case in Denver, it's a pretty good bet that most, if not all, developers are going to analyze what is the maximum amount I can build on this site, and they are going to do their damnedest to come up with a site plan and a design that will make that possible. And as Cassie pointed out, land prices increase based on what can be done with the site. In other words, if you have a piece of ground that's zoned you can accommodate 2 houses on it, it's going to sell for X. If you can accommodate 50 units on it, it's going to sell for some multiple of X. Even if it's the identical piece of property, same sagebrush, same trash in the corners, same whatever, it'll sell on the basis of its potential. So, and I think Cassie made this point, given that developers are driven by the combination of what kind of product does the market want and how much is the land going to cost. And they have to integrate that into a plan that yields a decent return at the end of the day. Now, before I came here, I went on to Googled land sales in Denver, and I came out, found this one. A piece of ground, and this is a really good illustration. This is basically a house. It's on a lot that contains 0.36 acres, or about 15,000 square feet. The asking price is $1.98 million, which seems like a lot. It is a lot, but it's not crazy. It's rational a lot, not crazy a lot. And okay, now let's take a look at that lot. That's the house, that's the rest of the corner. And it's typical little bungalows. And this basically shows what a developer can do with that lot. Basically what the developer can do is, under the current zoning in Denver, he or she can build 23,500 square feet of building. Assuming the average dwelling unit is going to be somewhere between 1,000 and 1,200 square feet, that means that, or maybe more, no, 1,000 and 1,200, because you're going to have a certain amount of space. You know, one thing you learn is that when you're building multifamily housing, you have a concept known as net and you have gross. The gross is the total amount of square footage which the zoning allows you. Net is how much of that is actually in the apartments that you're creating, not in the corridors, in the lobby, in the storage areas, and so forth. So anyhow, you could get 16 to 20 apartments on that site. And of course, there are lots, this area, you're seeing lots of these, exactly that type of building being built all over the place. And what that means is you're going to spend between $100,000 and $125,000 per dwelling unit for land, even before you've done any of Cassie's 11 steps. And what she didn't tell you is that every single one of those steps, they're not linear and they're not neat. Every single one of those steps has a built-in go to jail, do not collect 200, lose your turn provision built into it. And so if you're spending 100 to 125,000 for land, and let's assume that your construction, other development costs are going to be $200 a square foot. Okay. And you're creating 1,000 square foot units. So now, before you've built in your profit, your marketing, your other things, you're already up to somewhere between $300,000 and $400,000. And it goes from there. So, and if you're going to rent it, then you have to factor in how much are you going to have to pay in taxes and in operations and maintenance and management and insurance and reserves and everything else, and then work backwards from that to come up with enough rent so that you can get the return on equity that your investors expect. So the point is, this is what's driving the type of product that is being created. It's not because people have this yen to put up 3-story apartment buildings next to cute little houses. It's because it's driven. If, let's say, if we go back, is that, no, yeah, if we go back here, now let's say that a developer saw this land and said, the ideal use of this land is to put up 3 large but beautiful new houses that will be designed in a kind of a creative modern craftsman style so they'll be compatible with the area. Well, then the developer, now if the developer then goes back to the landowner and says, look, I know you're asking $2 million because I can theoretically build 20 units on this. But I only want to build 3 units because that's really what the neighborhood wants and what the site wants. And so I'd like you to sell me the land for $600,000. It's possible. Pigs sometimes do fly, but not often. Realistically, the landowner is going to say, I guess I'm going to have to find myself another buyer. So the alternative is the developer could buy it for $2 million, in which case she then has to spend $650,000 per unit for land, at which point the whole thing becomes totally insane. So all of this is being driven, again, it's zoning and demand. If the demand wasn't there, the zoning would be meaningless. If the zoning wasn't there, the demand would have no way of being satisfied. It's the juxtaposition of the zoning and the demand which is driving what's going on. So what happens? Land and housing both become progressively more expensive. The type of housing that gets built is the type that yields the highest return and covers the land costs. The density of that creates a trend towards the densification of the city and the neighborhoods. And clearly, that densification can conflict with neighborhood character. I love this. I was thinking of putting a caption, having a little bubble coming out of the apartment building, like in the cartoons, they have a bubble, a speech bubble, which was going to say, "You're next, buddy." But the problem is, of course, in a way, it's easy to make fun of this sort of thing, and it's easy to say something's wrong here and so forth, but it's not that simple. A city can't stand still. You can't, if you try to freeze a city the way it has been, the way you like it, the way you remember it from your childhood or whatever, the city will no longer be a living organism. So, at the same time, nor do you want to create the kind of design standards that make each one of these buildings turn into some kind of a faux traditional building with an imitation craftsman roof and imitation craftsman siding on it. So it's coming up with a way to keep Denver a living, vital urban organism and make the development fit into the neighborhoods is a very difficult problem. And you can't simply sort of freeze everything and pretend that change isn't going to happen, because that doesn't work. So I'd like to make a couple of suggestions. The first one is, I agree with Cassie to require 2/3 of the units be affordable is ludicrous. It's not going to happen. However, I do think Denver could have a stronger inclusionary ordinance than it currently has, and it would still be well within reasonable profit ranges for development. And I think the city clearly has to focus more on creating affordable housing. ultimately the market is not going to meet those needs. Another thing is to look at whether there are ways that the city can provide more incentives, not just for formally affordable housing, but for construction for some of the market demand that isn't the multifamily housing for millennials that is what's creating most of the product. Another thing, is I think if you go back to this machine here does not respond to my requests very well. In fact, I am swiping down. It is swiping down, but if somebody's up there, could you move the slides forward? Keep going. Keep going. Okay, stop here for a second. There should be ways, and I think, looking at, I think some people may have believed that when Denver went to form-based zoning, that was somehow going to make future development fit in. Form-based zoning is basically a good idea, but it's not enough. I mean, you have to, and this is where it really becomes complicated. Next slide, and then one more. Keep going. Okay. Is you really have to look at micro context and be able to adjust what you build or require that what is built is adjusted based on what's around it. Now, you could argue, in the case of there's some areas, like if you go back to the slide that shows this one, you could argue, why bother with making that apartment building contextual to these houses? Because maybe they're not going to be there in a couple more years. I don't think that's a good idea. I think it's important to try to preserve the context. And I think it's also important in historic districts, or for that matter in districts that may not have a formal designation as being historic districts or landmarks, that there be design guidelines that try to maintain greater sort of compatibility between what's new and what is old. And again, it's not a question of having design guidelines that require new buildings to look like faux examples of the Victorian West. It's a matter of making them compatible. I mean, one thing, and this is where I'll close on this point, is I think Denver has a fairly remarkable, even unique architectural profile from the late 19th and the first half of the 20th century. I mean, the housing types, the vernacular housing types that were created in Denver over that period, these brick bungalows, the flat-roofed duplexes, which I guess that's sort of a echo of the old Spanish colonial styles, things like this. This is a distinctive part of the city's history and its character. And I think for a city to be all, or for a neighborhood to become all new 3-story apartment buildings, it won't be the end of the world, but something significant will have been lost.
For all that, thank you so much for being here, and thank you so much for our speakers who did such a terrific job.